Hello friends, hope you guys are doing great. You are safe, healthy and strong. In this video, we are going to discuss about the buy down points or discount points. Now in the current market, the real challenge is the interest rate that is very high, right? Like 7.25% and 7.5%. And it is very difficult for the buyers to get approved for the loan. There are so many sellers who wanted to sell the property. There are so many realtors who wanted to close the sale. There are so many lenders who wanted to close the loans, and there are so many buyers in the market who actually wanted to buy the property. But the real challenge is again the interest rate. Because of this high interest rate, so many lenders are not able to get into their property, not able to get approved for the loan. So in that case, what we can do as an underwriter, right? Can we reduce the interest rate? Yes, we can. We can reduce the interest rate. How? By using the buy downs or discount points, right? It's a really a very good option for the buyers to get qualified for the loans. How it works, right? So that is what we are going to discuss in this video, right? So buy down. When I say buy down, there are two different types of buy downs. Number one is the permanent buy down. Permanent buy down, right? So what is permanent buy down? Permanent buy down is actually if someone is applying for a loan for 30 years, right? They can, purchase some discount points. So like if someone is going to pay for, I mean, buy down itself, telling that it's something we need to buy down, right, as a buyer. So if buyer is going to purchase 1% of the discount points, right, their interest rate said 0.25%. Their interest rate could be reduced by 0.25% for the entire 30 years. So 7% interest rate or 7.25% is the interest rate. If someone buy the 1% discount, right, their interest rate will become 7%. If somebody wanted to buy the 2 points, that means their interest rate will be reduced by 0.50%, right, for the entire term, for the entire term. So if someone is going to buy down, obviously they need to pay some money, pay some funds, right? They need to pay for it. How much amount they need to pay, how that amount get calculated, that we will see later. But as of now, we are just discussing what are the different types of buy down options, right? So this is what the entire term, and this is how the interest rate could be reduced. So their entire payment for 30 year will be calculated based on the 6.75% if they buy 0.5% interest rate, right? Now there is a second option, that is temporary buy down. So there is a second option, that is temporary buy down. What is temporary buy down? Temporary buy down is is a kind of option where buyer can buy the interest rate, right, based on the percentage, like 1%, 2% and 3%. Obviously they need to pay, but they can buy these different percentages of the interest rate for the 3 years or 2 years or 1 year. So these are the different options. It is also called 3 by 2 by 1. 3 by 2 by 1. That is what the option is called. It is temporary buy down. This means if borrower opt for 3 to by 3 to 1, that means their interest rate for the first year will be reduced by 3%. So that means 7.24% their monthly mortgage payment will be calculated based on the 7 minus 3, 4.25%. For the first year, for the first 12 months, they will be making the payment, or they need to pay the payment per month based on the 4.25%, their principal and interest payment. The second option is 2-1. That means their interest rate will be reduced by the 2%. So it will be 5.25%. There is third option, that is for 1, means 1% interest rate, and it will be reduced by 1%, so their interest rate will be 6.25%. Now let's say somebody opt for the first option, that is 3 to 1. In this scenario, for the first 12 months, they will be making their payment based on the 4.25%. Then after 1 year, automatically their interest rate will increase by 1%, and now they need to make the payment based on the 5.25%. After 2 years, they will be making their payment based on the 6.25% interest rate. Now from 4th year onward, they will be making the entire payment, or their payment will be calculated based on the entire or full interest rate, that is 7.25%. Now you might be wondering what will happen after 3 years, interest rate is going to be so high. Who knows that after 3 year interest rate itself reduce to 4% or 5%, then borrower can easily refinance their homes, right? So there are different options. So they can opt for, we are not getting into those options, but currently we are going to focus on the permanent and temporary buy down, how to calculate how much money that needed to be paid by the buyers, or who are the parties who are going to pay for it. You must have heard about the seller discount as well, right? So sometimes seller can also buy these points and reduce the interest rate for buyers so that they can sell their properties. So there are different options. We are going to explore more in regarding these permanent buy downs and temporary buy downs, also called discount points. How much discount point could be buy, could be how much discount point buyer can buy, right? Or what option if they go for in the temporary buy down, how much funds they need to pay. We will explore all this, right? So let's go to the worksheet, and we'll try to calculate and we'll understand more. It's going to be very interesting. Okay, so before we move on, if you like the video, please hit a like and also subscribe if you haven't done so far. Share the video if you know someone who is actually looking for a mortgage knowledge. Plus, we are going to start a new underwriting training batch from the next month. So if you are interested in the residential underwriting training, please feel free to contact number is given on the description box, or you can log in into the www.indigenousoutlook.com. there you will find my contact information. You can also send or share your information, your queries through the through the website. I will get back to you as soon as I receive your query. Thank you and have a great time.